Good afternoon. My name is Sheehan and welcome to today's Calypso presentation, Why Collateral Management Needs to be an Integrated Approach. I'm here together with my colleague, Sophie Marnhier-Foy. Together, we head product management teams at Calypso Technology. Sophie is responsible for the margin and risk solutions, and I'm responsible for the collateral management and securities financing solution. What we're going to talk about over the next 30 minutes is what we are seeing and what our clients are telling us regarding the growing need for collateral management to be more central to the whole trade and process life cycle. Partly, this has been driven by a raft of regulations from BCBS IOSCO uncleared margin regulations, and especially for the banks through the alphabet soup of SACCR, MCPFE and SFTR reporting, and even the LCR and liquid asset buffer requirements, but more generally needed by the need to reduce risk and identify whether there's a requirement to perform hedge trades. And then to make the best use of your inventory, your available assets to use to either lend, to pledge as collateral to cover your exposures, or to repo. In a moment, I'm going to pass to Sophie for the first part of the presentation, which will cover the pre-collateral management piece, or maybe more accurately, the functions that are consumers of collateral data. And then I will cover the post-collateral piece, or the areas where collateral management relies on data from other processes. We will touch on some lessons learned from the previous Reg IM implementation phases, some implications for IM entries coming into the next scope, and to try to explain some benefits of an integrated collateral management model and how an integrated approach can minimize the cost of collateral. Sophie, over to you.
Thank you, Alan. And indeed, the past few months have been quite challenging from a risk and collateral management perspective due to several key market and regulatory changes. The financial market had to adjust market risk and counterparty risk management best practice in order to adjust to the COVID-19 unique market conditions. In parallel, as you were mentioning, firms are going through a LIBOR transition and market changing pricing methodology. And in the background, there is the Basel III timeline, which is moving forward despite a couple of COVID-19 delays. The UMR and FRTB deadlines are coming up pretty fast. So now is actually a very good time to review how the collateral integration is at play as part of the end-to-end life of a trade. Let's review the timeline to see what's ahead of us. So there is a very long list of market changes driven by regulation, but what I have done here is highlight a couple of those that are pretty critical for the market. So the first one is BCBS 317, which is driven the UMR compliance. The next one is the fact that there are a lot of movement around increases volume in the clearing space. And then finally, there is Basel III with SFTR and FRTB, which have started to be implemented in some regulation and will be implemented in other regulation. So in summary, we have three main components at play. We have the uncleared margin rules that will affect most of the industry by 2021. We have cross-margining, which, as we are going to see, is impacting the exposure that is being used as an input to collateral. And we have new collateral charges in the form of counterparty credit risk and market risk capital charges. So what does all of that mean from a collateral integration and more importantly, trade cost perspective? Going back to the diagram that we were looking at initially, we are going to go around the life of a trade, starting from the pre-trade status to see how at every step of the life of a trade, collateral integration is key. So before you are going to do any trade, the first question you have is, who am I going to trade with and what type of trade am I going to do? And at that stage, it's actually quite important to be able to do a simulation because the trade you are going to prepare will be impacted by the initial margin that you have to calculate, whether you clear or you don't clear, is going to be impacted by the new capital charges we talked about, so SFTR, SAMR, and is going to be impacted by the XVA that you have to calculate. Very interestingly, all those items, all those risk metrics I talked about, they have a collateral component into them. So let's zoom a little bit into what it means to do a what-if simulation and how a trade will be impacted by a collateral input. So here I took 3 examples. One is a bilateral trade not subject to UMR. So as you can see, there are quite a few additional costs to the trade, but no margin. Still, in that case, we have the new capital charges, which are based on input from the CSA agreement, meaning required as an input from the collateral system. Then we have a bilateral trade, which is cleared, which is subject to UMR. So it's going to be requiring an initial margin. So as you can see, there is that new component. And then finally, we have a clear trade where there we have no counterparty credit risk, so less charges, but still initial margin. So it sounds that we have a good inventory, but it's actually more complex than that. Why? Because when you talk about UMR, you have to take into account UMR threshold, and the UMR threshold will actually drive your optimization even further. So let's look at that concept of UMR threshold. Here I'm using 3 trades that I would be doing with a single counterparty. Individually, trade by trade, I have an additional initial margin. So my pre-trade would show me that costs might be higher. But in reality, I actually have a threshold, a UMR threshold. And because my UMR threshold is actually higher than the sum of all my initial margin, I don't have to pledge any collateral. So this is really a key example where running a what-if and having a very strong integration with the collateral system will really help in that first step of being able to anticipate the cost and the profitability and the risk of your trade before even doing the transaction. Another example of optimization could be that you have a slightly more IM. So in that case, you still have to pay a little bit of IM, but way less than what you could see from a trade-by-trade perspective. So I think what we are seeing here is that we have a need to integrate with collateral even before we integrate, even before we trade, right? So now let's look at what's happening next. The next step is being able to run the valuation for your trade. So running the valuation means being able to calculate the NPV. And interestingly, depending on the counterparty you are going to select, you will need to find out which curves will be used from a discounting perspective. So until the LIBOR transition, there was the need to actually identify the currency in which you were going to discount and possibly the curves you wanted to use for collateralized discounting. Now with LIBOR into play, you also need to take into account the LIBOR fallback policy, because that will affect the discounting you will want to do for every single of your trades. So again, a strong need to have your trading platform fully integrated with collateral, because you need to always link your counterparty to a CSA to market data, right? So that's the pillar number 2. Now, we talk about initial margin a little bit as part of the pre-trade. Indeed, in every single trade, or almost every single trade, OTC or ETD, will be subject to initial margin when all firms are subject to UMR by 2021 and 2022 for the smallest firms. So what does it mean? It means that you need to be able to calculate initial margin for every single of your trade, whether it's clear trades. In that case, you will need to calculate a margin based on the OTC methodologies, or you might have to calculate NISTA-SIM margin because you need to comply with UMR. And then finally, as we're going to see a little bit later in more detail, you might also have to include an independent amount calculation in the mix by applying the margin flow approach. So quite a lot of complexity coming up as you are calculated this initial margin to be used for your collateral processing. Let's look a little bit at how those initial margin metrics have actually evolved in the past few months and how they are going to continue to evolve. So 2020 has been a year that has been very, very busy from a margin calculation perspective. Why? Because margin is directly driven and impacted by market conditions. Effectively, the margin parameters are coming from backtesting results, and the market has experienced unique movements in 2020. In parallel, there was ISDASIM 2.3, which was being prepared, which also changed basically the metrics and the parameters used to calculate margin. And finally, there was the CCP reaction, trying to deal on one hand with conservative margin because the market was moving, but keeping the procyclicality effect in play so that they would not ask the market for collateral margin calls that would be unreasonable. Very interestingly, again, while we talk about margin and exposure, we always need to have the reference of a collateral system. So what are we seeing in the market in terms of adjusting to the new margin landscape? And how does it actually rely on a very strong collateral integration? There are many different trends going on right now. So first of all, the margin methodologies, margin parameters are evolving. And very interestingly, not only they are evolving, but the link to collateral parameter is increasing at the same time. So for example, ISDASIM and the margin to be applied includes UMR threshold, which will be stored in a collateral system, right? There is a LIBOR transition, which is affecting pricing and margin calculation. And there is a market volatility, which is driving and causing impact on the application of the procyclicality effect. So what is the industry doing, and how can we help, or how can a full integration with a collateral solution help? Well, the strategies we are seeing in the market will first include a trade compression technique to reduce the scope of the notional that will be at play to calculate initial margin. We are also seeing some delta hedging methodologies to reduce the risk and as a result, reduce the initial margin exposures to be collateralized. We are seeing what-if techniques, and we just talked about it, as well as cross-margining, which again require a strong collateral solution so that you can have a net view of your listed trade and your OTC trades. But more importantly, at every step of the way, when you want to calculate this initial margin or optimize your initial margin or project your initial margin for the future, you need a very strong integration with collateral, because this is where most of the parameters will be stored, right? So that's what we are seeing in the industry, zooming onto that's not exactly new, but a very quickly evolving initial margin parameter. And then the last pillar I'm going to talk about is the risk management. Once the trades are executed, the risk manager comes into play and has to manage risk. And risk has evolved, in the application of the Basel III framework with new indicators, new capital charges that the risk manager needs to manage and monitor and calculate very carefully. Most of those new risk metrics that are now under the spotlight rely very heavily on collateral parameters. Taking SFTR as an example, SFTR is based on an exposure, and this exposure is actually either collateralized or not. And if it's collateralized, it will rely on CSA parameters like the margin period, the threshold, the initial margin that was actually received as part of that CSA agreement. There is no way to have an accurate and optimized SFTR management without very strong collateral inputs. So another part of the life cycle of a trade where having a very strong collateral integration is key. So I think we have covered the first half of the circle where we can see how, from a trading risk perspective, having very accurate and efficient collateral input is key. Let's now look at the second half of the circle.
Thank you, Sophie. Before I move on to the inventory management and the more post-collateral management piece, I did want to talk about an additional complexity for firms that are having to manage both Reg IM and non-Reg IM in the form of independent amount. Or really, I should say firms that are currently processing independent amount, but where those relationships will now fall under Reg IM. ISDA have proposed 3 methods for managing what is known as the margin flow approach: distinct, allocated, and greater of. And I've included the ISDA definitions here and included a link to a Calypso white paper on this topic. This diagram, which is from that white paper, shows the different impacts of the different options. What you'll see is that the distinct model on the left means that you continue to move your IA and also calculate and move your Reg IM completely separately. But this is the most expensive solution for the posting party. The extra collateral requirement coming from the distinct model means that more firms will want to use the allocated or greater of methods. The first complexity of these methods is in the calculation. In the greater of method, you first need to calculate your IA and then include this in your IM calculation. In the allocated method, you first need to calculate your IM and then include that as part of your IA calculations. Both cases make it much more difficult to manage your Reg IM agreements in a different system to your VM agreements that contain the IA. And then if we look at the financial impact, in both of these models, the actual amount of collateral that needs to be posted is the same. But with the allocated method, you make 2 movements, one for the IA and one for the IM, which makes this operationally more expensive. This would suggest that firms want to use the greater of method, which consolidates the IA and IM into a single collateral movement as Reg IM. The issue with this could be that it means your IA is now Reg IM, and therefore the collateral is moved has to comply with the Reg IM rules, and therefore must be securities collateral that needs to be segregated. Looking at the ISDA margin survey at the end of 2019, I was actually surprised by the value of the independent amount being paid to the Phase 1 firms. These graphs, which are taken straight from that survey, show that Phase 1 firms were collecting a total of $105.2 billion of Reg IM, but they were also collecting a total of $68 billion of independent amount. And if you look at the composition of this IA, just under 48%, or $32.6 billion, is currently in cash. And if all of this moved to the greater of model, that would mean another $32.6 billion of securities collateral would need to be segregated. So now, as Sophie described, we've minimized our IM requirements using pre-trade analytics. We've ensured we have the correct trade valuations, and we've correctly calculated and managed our risk. We need to ensure that we optimize our inventory. In order to make the best use of the assets to cover your collateral requirements, you need visibility of those requirements in a single system. The number of sources of exposures has increased to include exchange traded and OTC cleared derivatives, OTC bilateral derivatives, repo, sec lending, MBS, ABS, as well as requirements to manage tri-party pools and liquid asset buffers. For too long, too many firms have processed these requirements in a disparate set of siloed systems. We've seen firms implement their IM requirements in a new system and leave their VM both regulatory and legacy in old systems. Often these legacy systems don't have the ability to manage non-cash collateral or make use of tri-party services. But as I described earlier, this will become an issue for anyone managing Reg IM and independent amount, as 2 of the 3 methodologies require calculating those exposures together. But of course, the other issue is consolidating the assets that you can use to cover those exposures. I need to be able to identify where my assets are. I need to understand the quality of those assets, and I need to understand the forward ladder of my existing commitments for those assets. I need to understand how I can make the best use of those assets, which assets I can lend, which assets should I pledge as collateral, and which assets should I use for repo. and I need to ensure I have enough high quality liquid assets to cover any LCR or liquid asset buffer requirements. And once I have all of this information, I can make decisions as to whether I need to or have the opportunity to carry out any collateral transformation trades. And of course, I need to know the actual settlement status of my inventory to ensure I'm not going to fail on any of my deliveries. So once I've optimized my inventory and I've created the best, cleanest pool of possible assets to cover my exposures, I now need to ensure that I allocate those in an optimal way to cover the individual exposures that I have. So how can I do this? The simple answer is that I need to use an optimization algorithm that allows me to define my target, what I want to achieve. For example, I want to minimize my funding costs while also respecting the constraints, the conditions I must respect when making the allocations. For example, I need to look at the inventory that I can use. I need to respect the eligibility rules and concentration limits that are set on the relevant agreements. And I need to ensure that I consider any previous collateral that I've posted. I also want to consider whether I want to substitute any previously posted collateral. But here I'll probably be looking at corporate action impact rather than just the funding impact, as I'm sure we don't want to get into the nuisance process and the increased operational risk of substituting collateral just to reduce the funding cost. A recent study from consultancy group Allocation concluded that collateral optimization can have a 3 to 15 basis point savings impact on a typical bank portfolio, but also that in order to achieve this potential, the use of a linear algorithm becomes a must. I think one of the sometimes overlooked parts of the collateral management process is the settlement processing. And in normal circumstances, the settlement of collateral is almost taken for granted. However, earlier this year, in the most extreme period of market volatility, we saw an increase in the number of settlement failures, with our clients reporting clear difficulties of some institutions to fund their collateral requirements on a timely basis, leading to a delay in the collateral cash payments. Some institutions being obliged to liquidate part of their assets in order to cope with the collateral requirements, or subject to regulations, raise cash through the repo market. And some institutions did face significant losses due to incapacity of their counterparties to pay margin calls. In the first 3 Reg IM phases, we saw the huge proportion of regulatory IM was being settled through the tri-party agents, as the tri-party agents provide the bankruptcy remote segregation required under the uncleared margin regulations, as well as providing a simplified process model. As we moved into phase 4, we did see some usage of third-party custodian models, and as phase 5 and phase 6 includes financial institutions that will not have existing tri-party arrangements in place, we're expecting to see far more use of third-party pledge models. It's obviously key that settlement systems are able to manage the differences and complexities of the different models. One of the other things that I wanted to mention regarding the decision as to whether to use third-party or tri-party services is that our clients in earlier phases have advised not to leave this decision too late. Do not underestimate the amount of effort required to get the ACA, the account control agreements, or CTA, the collateral transfer agreements, in place. The custodians only have finite resources, and you do not want to be at the back of the queue for their account opening procedures. Of course, there are many regulatory reporting requirements across the different APAC regulators, but the specific item I wanted to point out is the one related to securities financing transaction reporting, SFTR, which, although is an EMIR regulation, impacts any firm with a European branch or European entity trading securities financing transactions, and especially the requirement to report the collateral that's been used to cover securities financing trades. Dating back to the period following the financial crisis, and concerns from regulators that the same piece of collateral may be being used multiple times for different transactions, meaning that that collateral is not providing the risk mitigation during periods of financial stress. One of the main requirements from SFTR reporting is the requirement to report on the reuse of collateral. If we look very quickly at the collateral reuse reporting, it's actually based on a calculation using this formula. And to rephrase the ESMA statement, once collateral is in your normal settlement account, you have no way of identifying what is collateral and what are your own assets. So they defined the formula to calculate the reuse. But because this calculation is based not only on the SEC financing transactions and the collateral on those transactions, but also on your trading positions, to correctly calculate your collateral reuse, you need to be able to consolidate your equity and your bond trading positions in a single solution to manage this reporting. And so to conclude, I hope we've shown over the last 30 minutes how many different aspects of the trade and processing life cycle are linked to the collateral management process, and how many functions rely on collateral management data, and how much of the collateral management relies on data and processes that belong in other areas of a solution. And to be honest, we probably haven't covered them all. And therefore, our diagrams have shown that we have placed collateral management at the very center of the universe. Certainly, our clients are telling us that one of the biggest challenges the market is facing is the transfer of data and the mapping of data between different systems. If you have multiple systems holding multiple versions of the information, you need to be able to normalize and also reconcile this data, which becomes a significant challenge and overhead. Of course, if you have a single system that can provide all of this functionality, then you remove the need to transfer data at all. Sophie, do you have any additional comments or any concluding thoughts?
Thanks, Alan. Yes, I fully agree with you that our clients are highlighting for us the need to have one integrated system with a very strong collateral platform. I would just add that what we've learned, especially in the past few months, is that we also need to be ready for the unknown. So that means having, if possible, everything in one system, because it's much easier to adjust. It means having a very agile process to be able to change parameters, change methodologies, or change the integration, and then be able to have a very, very quick time to market. That's what I would add. Thank you.